Thanks for tuning into this conversation. It's always a wonderful thing to end the year by talking to one of your favorite guests. And to my mind, over the years now, Raamdeo Agrawal has been the person that I look up to the most when I have to talk about anything about investing, markets, and corporates. And therefore, it's only apt that at the end of the year, we have him to talk about his outlook for 2023. Mr. Agrawal, great having you. Thanks for joining in.
It's a pleasure to be talking to you.
It's always a pleasure to talk to you. So, Mr. Agrawal, just wanted to understand, how do you see the landscape as it stands for 2023? I know 12 months is a very long time now, but still.
Yeah, it looks, Indian economy is very stable, Unfortunately, outside India, things are not so good. I mean, whether you take Europe, and I was just reading economist headlines. They're preparing for 3-4 years of war. It's just about 12 months. So I think it's going to be very long drawn. At least you have to take for granted that it will continue. So Europe that's 1/3 of the world. That's kind of in deep recession. US is slowing down because of inflationary problem. The inflation is now, I think, coming down. So, but still they want to really take it to the logical conclusion. So I think next year is also going to be a kind of slowdown for US. I don't know whether it happens to recession or not, or how deep is the recession, how prolonged it is, but it is definitely going to slow down. China, what is happening, I don't know, but
no one knows.
COVID and a whole lot of things. The headlines are not good, and there will a lot of attrition of business from there slowly but surely. People would like to definitely diversify, not exit, but diversify for the incremental requirements of the current concentration which is there in China. So the China plus one is definitely going to happen. So there are few beneficiaries of that. That of course, say like India, which is very strong domestic economy, and to some extent resilience on the software export side. So on external account, at least the software export is very resilient. The remittance is very strong, but merchandise exports is somewhat, it's not showing the momentum. But at the same time, the commodity imports which are falling, the price of that is falling off. So all in all, I think we have slowing world, but we have very robust domestic economy. So I would think we should grow at about 5-6%. So compared to rest of the world, will look absolutely shining. But related to India, I think it will be a slow, like a middle speed, I would say. I mean, if it is 4 to 7, 8 is our speed, will be more like 6 kind of thing, 5 to 6% would be the goal. I'm not an economist, but this is what I'm gathering from the paper.
Right. Mr. Agrawal, if you were a global investor, how would you look at India in that context, in that the country is not slowing down because of some of the decisions that the country is taking, but because of what the world might be going through? And as you said, if there is a prolonged period of Europe staying lower for longer, what does that therefore do to either the appetite for risk assets like emerging markets, and within that, an asset like India, which is not particularly cheap?
So I think as far as cheapness is concerned, every asset has its own value at a given point of time. Like India, where it is standing today, the growth potential is looking very robust, way above any other country, and for much longer period. I think that much longer period, like what has happened in the last 25 years, can continue without any problem for next 25 years.
You think so?
Yeah. Despite, I'm saying that today we have the stability, even after that, after 5-6 years, by chance, there is some level of instability. Even there it is fine, because in the last 25 years, we have seen all kinds of instability in Indian democracy. So coalition politics and all. So I think politics aside, India's time has come where I think growth of 6-7% is granted for many years to come. There could be some slowdown for 4-5 years, policy corrections will be there. But per se, because our per capita GDP is low, at about 2,500, global average is more like $10,000-12,000. So for us to catch up with that itself is a journey of 20-30 years. So I think we have a very, very good wicket. We are betting on very good wicket. Now, as far as the global investors are concerned, see, we are very domestic centric. I mean, for us, India is 100% almost. Okay. But for somebody who's allocating globally, I mean, they would like to be taking shots on the markets which are going to be very successful. Now, India is going to be very successful. It has been successful. The issue is that they are already over allocated by some measures. What is the indices which they are showing? India is already, those investors are already over allocated. So, what do they do? But if you look at the overall, like we are 3.5% of global market cap, headed towards 5. But I don't think the world is allocated that much on India. So I don't know how they resolve it. I mean, will they make India as a separate category itself and state allocates say 2-3%, 4% out of their total global this thing. But the kind of guys who are visiting me and we are able to talk to some people, it looks at very large buckets of money like $1 trillion, $500 billion. Those guys are saying that in next 7-8 years, 10 years, their intention is to go up to 8 to 10% of their corpus into India.
Wow.
Can India absorb? So I think outlook is good, is very good. It is for the policymakers also to understand the needs of these entities and conduct the policy in such a way that the growth is intact. Growth should be the top priority, and also you don't disturb the investment environment, whether it is taxes or permissions or regulatory environment should also be very, very friendly.
Yeah. And I think this is something that you referred to in the previous interview as well, that India is okay. The capital markets and the regulators should try and ensure that nothing too disruptive is done to ensure the smooth functioning continues.
Yeah, because they are used to, in any case, they are sitting there, they have to handle so many 10, 20 countries, laws and all. And then on top of it, you make something which is very unique to yourself.
Yeah,
but
sure.
then that kind of disturbs and in any case, you are a very marginal player in the global 1 or 2%. So they say, why bother about it? Last thing is they want to be in violation of anything. So so that slows down actually big time.
Sure, I get your point. Mr. Agrawal, I know you think really long term. I'm just trying to understand. Are you tempted, or one, do you believe that if indeed this US recessionary undertone picks up speed, if this realization that the war might be longer for us, there for longer, might all impact equities, are you tempted to kind of make a tactical bet that, hey, let me try and take advantage of an upcoming fall, try and time it, and then, or are you kind of fully invested?
No, I mean, we can all keep talking about it.
Sure.
We are not master, and nobody's master. I'm telling you, nobody knows whether recession is going to be there, how the world will connect, and how the money managers will do. Because at the end of it, what the central bankers will do, what the money managers will do, and finally what the stock market will do. So I think I don't want to play with that. I don't think it is in anybody's control, particularly market moves. So there are too many uncertain things. I would rather take a lower return for some time, or no return for some time. But I would not like to be out of the market.
Got it.
Because I will not get I mean, even if what you're saying that okay, there could be 10%, 15% correction. If that correction happens, okay, I can't catch the bottom.
Of course.
Even if I'm right, if I'm wrong, in any case I'm wrong. But if I'm right now, I have to be wrong the next time to pick it at after the 10, 15, 15. That's not my skill.
Yeah.
So I would not venture there. I may not be very aggressive, but I would like to stay invested broadly 100%.
Yeah. Viewers, in an interview on, I remember, 23rd March 2020, Mr. Agrawal had appeared on then Bloomberg Quint and spoken about how the bottom belongs to the person who is invested, because nobody can time the bottom. And I think that narrative probably still stays. Yeah. Now, Mr. Agrawal, I want to kind of combine the next 15 minutes of Outlook 2023 with what has been yet another really good read for me of the wealth creation study. 27 years, long time. To my mind, and please correct me if I'm wrong, but what you probably try and do every year, amongst other things, is identify newer ways of identifying businesses in which you would want to invest or stay invested or identify. Would that be the summation? Because this time, consistent and volatile, I mean, it's a fairly interesting mix that you've gotten in the study.
Yeah. So actually, my effort is to learn something about investing, because in investing, you have to be a student right till you die. I mean, it keeps evolving every day. There's so much happening, and with the social media, information technology, communication, there's so much happening, and so little is known. I mean, because ultimately, more you know, more it becomes complex, and more money is coming. More, the intelligent guys are coming, running algos. So I think markets are evolving. At the end of it, market is evolving. Particularly shorter term is a lot more confusing. Longer term remains more or less. I mean, longer term is much more predictable, I would say,
Yeah.
compared to the shorter term. Shorter term has become very complex. So you keep learning, and the verification study has been, kind of whatever is the question in my mind. One of the intriguing question I would like to pick up for the study in that particular year. So, like one of the things was that we talked about buy and hold. We always talk about buy and hold, and hold it forever, buy right, sit tight. But that was so that theme is very good. The issue is that that is applicable only to consistent companies, the companies which broadly are predictable. If the companies are not predictable, you can't use that. And let me tell you, only 20% of the companies broadly are predictable. 80% companies are volatile. So we were practicing something with the same. See, once you get a trick, you try to do the same trick on everything you have. So when you get volatile, which goes 10 steps forward and 8 steps back, compounding doesn't work that smoothly. So the rules of investing into volatiles are very different from rules of investing in consistent. Consistent we have more or less talked about, in the sense that all the work we have done for 25 years is trying to figure out, but we didn't say that. We didn't say the formula we put QGLP and buy right, sit tight. That's all about consistent companies. Volatile companies are very different. So in volatile company, what happens is that there are phases when they are depressed, very depressed, like a despair valuation kind of thing. At that point of time, despair valuation, from there it goes to optimistic valuation, that from there it goes to hope and then growth and then optimistic. The 4 stages of psychology. Now, in the first stage, when it despairs, or from optimism to this, so I'm calling the fall as a starting point of any volatile company. You between despair valuation and optimism, you could be talking about 5x of valuation change from half book to 2.5 book, just the valuation parameter. And then what is the change in the book itself is different story. That so we focus on that. So if your book is growing at 15%, in 5 years you'll go from say 100 to 200 bucks. But if you are able to buy that 100 at half book and sell at 2.5 book that 200 rupees, you are talking about from 50 to 1000. So 20x. That happens within a very brief period of 5-6 years. But getting the bottom and getting the top, it's good to talk here. It's not that easy. But those kind of things are there. Even if you get it 20-30% into the game, and even 20-30% before, I think you'll beat hands down the indices, and you'll do very well. But that also requires mastering the technique of buying. And so look for the large companies which are in despair today. Always you'll find all of them are not blooming. There are always some sectors some companies which are in bad shape, dire straits. Say oil refining companies. Thanks to all these problems, government wanted to control the inflation. So they are in deep trouble. 5-6 lakh crore companies are available now. Digital companies, what it was last year, what it is today. So that, and despair phase is on. I don't know where it is going to end up. So there are always some section, because markets cannot afford to be at top even at the high. So right now you're an all-time high, and yet market cannot afford to have say 50 sectors. All 50 sectors will be there. There will be at least 10 to 12, 15 sectors which will be in despair phase, and another 40, say 35, 40 sectors will be in good phase. So you have to figure out how you play the volatiles. First thing to recognize, there are 2 types of companies. Not all of them are same, something is black, something is white, that kind of thing. So that, in my mind, it is very clear that when cyclicals are there, either you don't touch them, but if you touch them, then the rules are very different. You buy low and sell high.
Is Mr. Agrawal doing that?
No, I've just done the study. Just done the study, and if something I come across large, which I understand, and it is in despair valuation going towards that, or it is just coming out of that, I don't mind playing that.
Okay, you don't mind playing that.
Yeah, I mean, I have to learn somewhere, and unless I play, I put a percentage or two of that in this thing. I don't think I'll be able to master the technique.
So that's therefore my question. The likes of, let's say, the oil market or OMCs, or for that matter, a bunch of PSUs wherein the dividend yield currently seems to be very strong. Are these pockets where you might believe that they are not, because the history doesn't support them, but you are tempted to because of
so I mean, these are the spots where you should go and do your research.
Got it.
See, because it's not, there's no set formula that you buy price to book half and just make money. Not like that. But you have to understand every other aspect of it. What is the potential? What will drive? What will lead to growth, or what will lead to optimism in that particular counter? What will things turn around? So those things you have to do research. That in any case we're doing. Just that we're thinking that it is buy and hold, even if it is a volatile company. That's where the mistake was.
Got it. Got it. And now you've distilled that.
Now
I mean,
that's what is a
study all about.
Yeah.
Got it.
Basically, what happens is that consistency of any company. See, consistency means increasing profits consistently year after year. During that period, only wealth is created. Now, consistent companies are the companies where, say, 7 or 8 years out of 10 years, it will be growing. 1 or 2 years, there will be some setback. Okay, it's a business.
Sure.
In a volatile company, it is just the reverse. Only 3-4 years it will grow, and rest all 5-6 years it will be falling. So during the period of those 3 years, whatever you gain, that you lose in 5-6 years. So at the end of 10 years, you have gone very little ahead. Whereas in consistent companies, because the consistency period is very long, you just keep marching ahead.
Mr. Agrawal, 2020 onwards, the world has been anything but steady. It's not been consistent. It's been very, very volatile. From what you are telling me, 2023 could also hold more promise of the same. Therefore, are you looking for consistency in a volatile world, or are you looking increasingly to take advantage of volatility in the markets in a volatile world? What is it that you are tilting towards now for 2023 or 2020?
So
next few
markets
years?
are always volatile. I mean, sometimes it looks to be more volatile than other times. Yeah, right now it is more uncertain, volatile. Yes. So the consistency, I would look for consistency which is ignored by the people, or because of some COVID or COVID exigencies, the companies have broken down their earnings growth. So I would like to get into those companies where temporarily it is broken for some reason or that, but they are fundamentally consistent. I am not going to have more than I mean, at least 80-85% of the companies in my portfolio will be consistent. Somewhere, I mean, you can't be God that even your consistent companies, they also become volatile. You know, I mean, you buy as a consistent, thinking consistent, but it turns out to be volatile because something happens and the earnings track breaks down. So those things will happen, but predominantly I'll keep buying consistent companies, and whenever I get some absolute eye-popping opportunity, I don't mind. Earlier, I used to be very scared of looking at them.
Got it. Where are these names? I mean, what themes? The consistent ones which are temporarily having an issue? What themes, if you will?
So like some consumer companies, they were broken down because of COVID. I mean, the doors were shut altogether. So during that year, they didn't make any money. So instead of, say, somebody is making 100 crores, next year they are making, say, 10 crores, 20 crores. Obviously, it is broken down. But actually, it is not broken down. I mean, unless you believe that COVID is going to come every 2 years.
Yeah.
You know, so if you think that it is once in a lifetime situation, but market doesn't spare anybody. Market just, if your earnings are broken down, come when your earnings are good.
Sure.
You show me the earnings and you get the valuation. So it is that kind of market. And I mean, so market is like jo dikta hai bikta hai. If it is visible that your earnings are broken down, so price is broken down. If your earnings are going up, your price is going up. I mean, it's that simple.
Sure.
There are always some exceptions, but that's how I believe markets generally work.
Okay. But you seeing some of those evidences available even now. Let's say a consumer is one during COVID, but now we, at least in India, it seems to be behind us completely. Maybe Chinese think about it differently. So where is it that you believe there is an impact of some uncertainty in some of those consistent companies even now? What themes still have that opportunity?
Yeah, so automobile were not that inconsistent.
That's true.
Before the COVID, but after that it became quite. I mean, there were no sales,
Yeah.
And now they're all coming back. So again, you have to look at those companies. I mean, I suffered a lot because I kept it as a buy and hold, and earnings broke down, so prices broke down, so our performance also suffered. But now they're all coming back. So even in the banks, there are two types of banks: consistent and again volatile. But now credit cycle is so strong and likely to be so prolonged that even volatile banks are coming from half book to now one book, and it might be 2 book or 2.5 book if the credit cycle remains very strong for a very long time.
Yeah, it seems to be a consensus out there on
There are a lot of
BFS.
consensus there.
Banks at
Yes,
least,
yes,
not
yes.
other.
Banks. We have been talking about since the credit cycle has, because what has happened is in banking system, after a long time, once you have IBC code, you have before that COVID itself, you know, IBC code itself cleaned up the book, and after that, double cleaning happened after COVID, and after the lending itself has not happened. So this is the first flush of lending. So it will require books to be rebuilt by 50, 60, 70%, or maybe even double in the next 4, 5 years. And then at that peak, you'll realize that people again, have become lax about the risk in the lending.
Mm,
And maybe the risk might come from consumer side rather than the corporate side. Corporate side is now all the borrowers and lenders both have become extra cautious.
that's true.
So most likely, if the trouble comes, it will come in different format altogether. Now it could be from consumer or mid-end or something like that, or microfinance. I don't know. So, but then first you have to build the book, which is going to 2, 3 years, and then I think the bad lending will start, and then finally, it will the credit cost will catch up.
Got it. One narrative being built for PSU banks is that kharab sector hi nahi rahe. So therefore, they will not have as bad a cycle as they've had in the past. Would it be prudent to wait for a cycle's performance to come in the proof before you take a large bet there? I mean, how are you approaching
No.
them?
You have to. I mean, you have to believe in what you're thinking, and then how long will you keep waiting? What are you waiting for? I mean, already few quarters of good results have come, and in fact, recovery process has been very, very accelerated. So the profit growth is quite massive. And books are clean. Basically, books are clean. It has not grown. They're growing very cautiously. So the economics are in place right now. So I think if the valuations are very attractive, it will come back to some. You cannot have in good time also half book and bad time also half book. It just cannot continue.
That's true. Mr. Agrawal, the other piece of the wealth creation study is also how the past is the best indicator of what some of the companies might be able to do in the future. That came out very strongly in the book, in the study. Now, my question is, let's say, for example, a space like defense. In the past, if we look at the past, it's consistently disappointed, so to say, barring one or two.
In terms of growth, yeah. So that's where you have to see, because they will remain same. I mean,
I
there
was
could
gonna
be a
ask you.
3, 4 year window. Or see, now that's where the knowledge comes that, okay, I mean, now we are very clear. Now we're talking about Atmanirbharta. For the first time after so many years, we're talking about Atmanirbharta. So our domestic arms manufacturer, ammunition manufacturer will be overloaded with order for decades to come. If that is the thought process, then obviously consistency will come in those companies.
Sure.
And some companies were in any case consistent, like Bharat Electronic or one or two companies, they were consistent but slow growth. Okay, but now they'll not only be consistent, if they have remained consistent for last 10, 15 years, they will remain consistent for next 10, 15 years when Atmanirbharta is in the full swing. And there will also be growth because more orders will come to them. So that's how you have to go one by one. What's happening to the naval yards? All the naval yards are loaded with the new orders for submarines and frigate and destroyers and all those kind of things. So you have to get into those programs because one of the things is that defense programs will be very lumpy.
True.
So you have to be careful what you're buying, at what price you're buying, when you're buying. So those things are, investment risks is not mitigated in any way. If you end up buying at some crazy price, you'll again suffer. So like say digital now is in despair phase. So actually one should take a lot of interest in the sectors or companies which are very large, but which are which are unpopular, which are going through maybe even unreasonably lower valuations, because nobody wants to have them. 1 year back, everybody wanted to have only that. Today, nobody wants to have them. So that change gives, it is more because of the psychological breakdown of the investors. One is the story leads to the fall in the prices.
Sure.
Then psychological breakdown happens of the investor in groups, in a crowd situation. And that breakdown, there is only seller, there is no buyer.
Sure.
That leads to that, bottom falls through and some kind of and that's where the smartest investors, they walk in. Unlike us, Teji mein Teji, Mandi in Mandi. These guys are Teji in Mandi and Mandi in Teji. So that reverse thing psychologically, That is a matter of maturity, psychological maturity of the investors.
Hmm. I've noted down a couple of questions.
Mm.
In the actual wealth creation in the
Mm.
last 5 years, the Adani Group stocks have been the biggest and the most consistent wealth creators. Right now, but there's a fact of the study can't be refuted.
Mm.
Now, does the is you know is there an opportunity here because the biggest wealth creators is the market mispricing some of these? And I'm not just sticking to one group name. And standard disclosure, of course, they own 49% in the platform that you're watching.
Mm.
But is the market mispricing some of these opportunities, or is the market thinking uh, a few quarters, years ahead because the opportunity size may be large? How do you think? Not, and I'm again not just this group. I'm talking about anything which is.
Yeah, see, one of the feature of this study is that all the large companies or consistent companies or even growth companies, they have been re-rated big time. Earnings, the amount, say 28% is the compounded growth of the entire 100 companies which have come in the study. But that 28% has not come largely because of earnings growth. It is 50-50 types.
Okay.
50% has come because of re-rating, compounded re-rating of 10-12%. Okay, I mean, of course, Adani's and these guys are bulk, larger share of that. Like Adani Transmission is compounded earnings decline is about 4%, but compounded price growth is about 100%. So you're talking about on a flat earnings or declining earnings, you just have the re-rating of double. So obviously there must be a story what's going to happen 5, 10, 15 years henceforth. It must be very giant story. But the re-rating has been quite balancing across. Of course, far more pronounced in these companies, but other companies also are not, even TCS or most of the companies, they have the re-rating.
Got it. Last couple of points, Mr. Agrawal. One of the points which you highlighted in this study as well is that excellence in execution is non-negotiable for consistency. Now, obviously, companies which have consistently excelled in execution would already be priced, right, in some fashion. Therefore, they are consistent. And so, what about some of those companies which have consistently executed? Some of the FMCG majors, some of the paint companies, and they are having a slightly iffy last 6 months because of multiple reasons: rural consumer, raw material prices, etc. How do you think about them in the current landscape?
Yeah, so that's see, I would say two types of consistency are there. One is the known old hawks, like TCS, Unilever, Nestle, Asian Paints, I mean Pidilite. They are all known consistent and they will remain so. As it is believed that they will remain so.
Yeah, sure.
Okay, that's one. Second is the emerging ones from the same industries, the newer ones which are coming in. And that is where the opportunity is. Market may not be, what happens is, say, listing happens today. But it doesn't mean that company is born today.
Of course.
Company is there for 10, 15 years. And those data are available in your database. It could be, the company could be listed 1-2 years back, but the data is for 10, 15 years. There you must see whether these companies, when the company is coming, immediately I am seeing whether it is a predictable company or unpredictable company. Is it a volatile company or is it a consistent company? If it is consistent, I take a lot more interest because market is still unaware of them. What market wants after the listing, 4, 5, 6 years when you are consistent, then market says you are consistent. But you have an opportunity to see back.
Got it.
So those are the matter of research, and we have put out some of the names which we think is not yet emerged in the minds of the market, but we think there is an opportunity to look at them.
Yeah. As much as I do it every time, Mr. Agrawal, when I get the hard copy of the study, I go to a Starbucks. Somehow, I don't know why, but I go to a Starbucks, as noisy as the cafe may be, and I sit down there for 6 hours and try and go through and make physical notes with a pencil and a book. And it was quite wonderful to do that this time as well. So I thank you for that. I have one final question on this interview. When you look back at 2022, either one good book or a good hobby or a good habit, health habit, or what have you, that you picked up, that made a difference in your life and that you would be happy to recommend to others. People can choose to do it whichever way, but something.
I don't know why should I recommend anybody, but I think I started learning golf last year. It's almost 6 months now, 5, 6 months. I've been at it three times in a week. So that's been a huge, I would say, eventually it might turn out to be a big change in my life. And I love it in the sense that it's today also I played before coming here. So it is good. I'm preparing. I'm not a hardcore sportsman, so I think this is one sport. One I would like to what do you call it, inculcate in me for the little older age, I would say.
But I mean, is there a specific reason why you're doing that, aside of the fact that you may like it? I'm just trying to understand how would a viewer pick up as to why is it that Mr. Agrawal is talking about golf?
I mean, I like it. I like the sports. That's why I want to pursue that. And I still have not bought my set. I'm playing on some friends borrowed set
Okay.
because I was not sure whether I like it.
Uh-huh.
So this is part of the health management. In the sense that you have to walk for 5 kilometers. So I walk in any case. But the day on which I'm playing, then that day I play 8-9 holes. So in that I walk for 4-5 kilometers.
Got it.
So it's part of the doing it a little better than just walking plain.
Got it. Okay. Mr. Agrawal, lovely as always talking to you. Thank you so
Yeah.
much for speaking
Thanks.
to us today.
Thanks for coming.
And to you and your team, a fantastic 2023.
Thank you.
And viewers, thanks for tuning in.